Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Wednesday afternoon, April 29th, 2015, and the title of today's audio blog is Earth to Janet, No One's Listening. Actually, it's still Wednesday morning, several hours before yet another all-important FOMC statement. And as usual, there are so many horrible headlines to report, I could probably write a book before Whirlybird Janet takes center stage at 2 p.m. Eastern Standard Time and embarrass herself, her nation, and her disgusting world-destroying institution yet again. The titles of my recent post-FOMC commentaries were The Death of Fed Credibility last May, Laughable FOMC Statement Sets New Central Bank Low in December, The Most Unequivocally Dovish FOMC Statement in Memory in February, and New Lows of Fed Idiocy and Cluelessness, and FOMC Lunacy Opens the Gates of Financial Hell in March. And without a doubt, the 120 taxpayer-funded printing press finance lackeys redlining the April FOMC statement this morning will give cause for yet another ugly post-statement article title. In fact, following this morning's utterly horrific GDP report, I'm frankly looking forward to seeing how moronic the Fed sounds in trying to convince the world that yes, the economy continues to recover, and yes, a rate hike at some point in the distant future will occur. But no, there's no such plans or even considerations of such yet. Due to uncertainties out of their control, like the collapsing global economy, and transitory phenomena like low oil prices, despite Whirlybird Janet just 4 months ago having called low oil prices a net positive for the economy. As I discussed in yesterday's article, De-Fiatization, I don't believe anyone's even listening to the Fed's idiocy anymore, and that instead the only remaining policy tool it has is the relentless 24/7 manipulation of every market imaginable to try and portray a picture of economic health, let alone recovery, that simply doesn't exist. Heck, even the government's own economic data, Island of Lies reports like NFP employment and all, is now screaming recession, if not depression. Before I get to today's FOMC statement, a few other horrible headlines to discuss, starting with one near and dear to my heart, i.e. the utter collapse of what I have long railed at as a despicable representation of how far American society has degraded, Twitter. A Saudi cleric recently called Twitter the root of all evil. And while I wouldn't go that far, I truly believe it provides absolutely zero positive impact to society and a tremendous amount of negative. Between Twitter and the tsunami of brain-draining social media sites that have engulfed America like the plague, America's youth, and countless others, are becoming mindless, smartphone-addicted zombies whom pretty soon will no longer understand the meaning of the word book. Anyhow, it's not just the social context of Twitter's demise that I'm railing about, but the fact that, as I have highlighted countless times before, at least a third, if not significantly more, of current social media traffic is fake, just like so many other aspects of our increasingly corrupt business world. In other words, the same algorithmic bots that have even boosted the Miles Franklin blog's traffic with fake email addresses now account for a massive proportion of the so-called growth of Twitter and other online organizations, overstating every imaginable economic metric such as advertising utilization. In time, I believe the entire social media space, perhaps with the exception of Facebook, will be annihilated by this painful reality, and good riddance to these dot-coms of the 2010s, created largely by a decade of ultra-loose central bank monetary policy. And FYI, for those that don't understand how CNBC can have its lowest ever ratings, with the stock market, unadjusted for inflation of course, hitting all-time highs, here's what Jim Cramer said about Twitter last week. Quote, "We believe Twitter is partially out of the sentiment doghouse heading into first quarter 2015 results next week, but is still largely underowned relative to the most large-cap internet stocks. Twitter has likely the greatest array of company-specific catalysts of any company in its sphere and should grow well above average over the next several years. In fact, we think Twitter has more revenue runway than any other company in the internet space." Next up, we have far more important topics to discuss, although frankly, if the social media, biotech, and other historic bubbles in any way start to deflate, it could be all-out market carnage. which is probably why, following Japan's biggest retail sales plunge ever, ironically published the week Abenomics was originally supposed to end, a former Bank of Japan governor claimed that not only was an end to Abenomics, quote, out of the question, but even consideration of an exit would be a nightmare. Meanwhile, in China, as its economy, by government admission, has fallen to its weakest level since 1980, before it had accumulated any of today's 28 trillion of debt, the PBOC has ignited a 1999-style internet mania by promising endless monetary easing, to the point that an incredible 4 million retail margin accounts were opened last week alone. In fact, the PBOC went so far as launching a trial balloon Monday by circulating a rumor it is considering the monetization of collapsing local government bonds, which, if it were to occur, would be China's first foray into overt quantitative easing. If they are insane enough to do this, a wave of inflation would wash over China like a tsunami and likely commence a chain of events that could have profoundly negative, likely permanent, impacts on the global political, economic, and social structure. Undoubtedly, such an admission of economic collapse would also yield intensified discussions as to whether the PBOC should indeed depeg the yuan from the dollar, escalating the final currency war I have spoken of for 2 years to DEFCON 1, as the yuan would likely precipitously collapse, which in turn would likely force the Chinese to announce the massive increase in their gold reserves we all know is coming, in order to stop the currency bleeding. Subsequently, the ripples of gold as money would spread like the Ebola virus, including heightened calls for national repatriations, audits, and sound money. Oh, what a tangled web we weave when we seek to deceive. And then there's Greece, which is so hopelessly broke it can barely pay its day-to-day bills. With each day that passes, the consternation, angst, and desperation of all parties involved, from the Greek government to the Troika to the Greek people, is exponentially increasing, let alone citizens and politicians of other financially hopeless nations, many in Europe, including France, Italy, and Spain. I continue to believe a 2015 Grexit to be virtually guaranteed, and when Pandora gets out of that box, Europe and all economies tied to it will become a very, very scary place. As will any and all currencies tied to Europe, such as the euro, pound, and Swiss franc. And do you know what? I won't even mention yesterday's Iranian seizure of a U.S. cargo ship, as God knows the amount of Middle Eastern black swans already swimming around is daunting enough. Next up, there's those transitory oil price declines, which won't be helped by the relentless build in global inventories, such as yesterday's API and today's EIA data. U.S. inventories are literally off the charts, and with misguided government tax incentives set to hit this summer, the nation's beleaguered shale producers will likely ramp up production further into a rapidly collapsing economy. Saudi Arabia has no inclination at all to cut production, let alone at its June OPEC meeting, and has loudly stated as much, whilst an ill-timed Iranian nuclear agreement could unleash up to 1.5 million barrels per day onto a market already oversupplied by 1 million barrels. Meanwhile, even I was shocked to see that year-to-date, the collapsing shale industry has raised more equity than in any full year-to-date, and more junk bonds year-to-date than at any time ever. In other words, the deformation of financial markets and economies I have long written of has gone into hyperdrive in the past 4 months, creating what could be an historic long-term glut in the only industry that has provided jobs, income, and growth since the 2008 financial crisis. And last but not least, we have the U.S. economy, which per this morning's horrifying 1Q GDP report is in full-scale reverse. While Wall Street was expecting 1% growth, as if such numbers are material to start with, is beyond me, given that the Atlanta Fed's tracking metric was sitting at 0. However, it was, so it came as a big surprise when the actual number, which may yet be downwardly revised, came in at just plus 0.2%. Worse yet, the GDP deflator came in at negative 0.1% compared to expectations of positive 0.5%, as the BEA, or Bureau of Economic Analysis, tries to convince us our cost of living actually declined last quarter. And for those that actually believe the weather was a factor, notwithstanding the fact that BEA seasonal adjustments were created to offset winter weather, or that this year's winter weather was actually better than average, The most damning evidence yet of such lies was that business capital expenditures, which are completely immune to seasonal weather factors as opposed to retail sales, had their weakest quarter since, drumroll please, the 2009 financial crisis. And yet, this isn't even the worst part of the GDP report, as the only reason the GDP number wasn't an utterly horrifying negative number in the ballpark of negative 2 to 3% was because of, drumroll please, the single largest retail inventory build in U.S. history. In other words, not growth at all, but debt-fueled manufacturing of as-yet unsold items, which not only will need to be liquidated at dramatically lower than expected prices, but will serve as a massive drag on GDP growth calculations for quarters to come, making it all but certain that, recovery notwithstanding, U.S. GDP growth, weather, book cooking and all, will be lower in 2015 than 2014, and possibly, if things continue to get worse, negative. Anyhow, it's now 11:30 a.m. Eastern Standard Time, and the PPT has been doing everything in its power to prevent stocks from plunging as they are in Europe, whilst the cartel is using every DLITG or don't let it turn green algo imaginable to prevent gold from surging, following its shocking two-day surge, albeit blatantly capped on Monday and Tuesday. Ironically, the 10-year Treasury yield, despite this morning's GDP disaster and countless other economic data failures in the past month, has risen to 2.05% before the FOMC statement, despite not a chance of anything other than dovishness as far as the eye can see. Of course, this is far lower than the 2.25% rate the 10-year yield reached before the March meeting, before subsequently collapsing following the same uber dovishness I anticipate today. As Zero Hedge put it, the mysterious Treasury seller we have seen for the past 2 weeks showed up again this morning, right after the aforementioned GDP disaster, just as the mysterious oil PPT continues to support oil prices despite the aforementioned horrific oil fundamentals. Regarding the former, don't forget for a second that China has been actively selling treasuries in recent months, and if it is indeed them selling, the Fed will be facing a whole new hell at future meetings, knowing full well interest rates must be kept near record low levels to prevent history's largest debt edifice from instantaneously collapsing. In other words, QE4 here we come, as the Yellen reversal I have warned of since QE supposedly ended last October, LOL, draws closer with each passing day. Okay, I'm off to tape 2 podcasts, and after they're done, it'll be time for the FOMC statement, which, as you can imagine, I'll report on in extremely fine detail. Well, it's now 2:15 p.m. Eastern Standard Time, and I am so nauseous from reading this historically pathetic FOMC statement, I'll be lucky to get through this podcast without vomiting. Everything I said above about the Fed's lack of credibility, coherence, and understanding of the economy has been magnified to the umpteenth power, and clearly today's audioblog title was aptly chosen. Frankly, it's hard to believe anyone believes a word they say anymore, or should I say, the words put together by 120 taxpayer-funded lackeys. To refresh your memories, here's what the Fed said in December, which in a nutshell was, we're changing considerable time to patient, consistent with what we meant when we said considerable time, to wit from December 17th's policy statement. Based on its current assessment, the committee judges it can be patient in beginning to normalize the stance of monetary policy. The committee sees this guidance as consistent with its previous statement that it will likely be appropriate to maintain the 0% target range for the federal funds rate for a considerable time. In other words, they simply interchanged considerable time with patient, going to great pains to make sure readers knew the two meant exactly the same thing. Well, if you thought that historically pathetic exercise in grade school wordsmithing was bad, then consider what they did in March, essentially repeating the same brain-dead game by changing January's language that, based on its current assessment, the committee judges it can be patient in beginning to normalize the stance of monetary policy, to, consistent with its previous statement, the committee judges that an increase in the target range for the federal funds rate remains unlikely at the April FOMC meeting. In other words, they simply replaced the considerable time catchphrase with the patient buzzword in January, and in March they got rid of all catchphrases and buzzwords entirely by simply saying they won't raise rates at the April meeting. I mean, just how stupid do they think the world is? Other than the morons in the MSM, of course, such as Reuters, which immediately issued a headline espousing Fed opens door for rate hike, even as it downgrades economic outlook. Well, fast forward to today, when the FOMC statement was not only pathetic, ambiguous, and decidedly dovish, but lazily constructed. In fact, after I go through it, even a reasonably intelligent 10-year-old will understand it makes no sense. And as for anyone that actually has knowledge of the financial world, like, say, the Chinese, they are going to be rushing to the nearest bullion dealer or jeweler to load up on gold and silver. In other words, the path to QE4 drew dramatically closer today, and never will more people be more certain that the world's economy is being managed by a rudderless ship. Okay, let's start with the first of the comically moronic red-lined changes. At the March meeting, they claimed, information received since the January meeting suggests economic growth has moderated somewhat. However, labor market conditions improved further with strong job gains and a lower unemployment rate. A range of labor market indicators suggests that underutilization of labor resources continues to diminish. In other words, they completely contradicted themselves by saying the economy slowed, but the job market they so passionately focus on got much stronger. This time around, they said information received since the March meeting suggests economic growth slowed during the winter months, in part reflecting transitory factors. Moreover, the pace of job gains moderated, and a range of labor market indicators suggest the underutilization of labor resources was little changed. Of course, they don't tell us what such transitory factors are, which is quite important, huh? Remember, Whirlybird Janet herself told us in December that lower gas prices were a net positive for the economy. And since this winter's weather was better than average, and should be seasonally adjusted out anyway, I'm at a loss to guess what transitory factors negatively impacted the economy. Moreover, if indeed the weather is to blame for the economic weakness since the last meeting, I'll remind you that the last meeting was March 18th, i.e. as winter ended, and today is April 29th in the full glory of spring. And by the way, if low gasoline prices were indeed a net positive for the economy, perhaps the Fed should take a look at the pump, where despite horrific supply-demand fundamentals, gasoline prices have been soaring. 0.2% first quarter GDP growth with my average gasoline price around $1.80 per gallon, and now with the second quarter just starting, it's up to $2.30. That can't be good, unless, of course, Whirlybird Janet changes her mind and calls high gas prices a net positive for the economy. Okay, next. Back in March, a whopping 6 weeks ago, the Fed claimed household spending is rising moderately and declines in energy prices have boosted purchasing power. This time around, they said growth in household spending declined and households' real incomes rose strongly, partly reflecting earlier declines in energy energy prices, and consumer sentiment remains high. Okay, how many ways can I take this garbage apart? For one, to say household spending was rising moderately between January and March, when both retail sales and personal consumption spending declined, was a flat-out lie. Let alone at a time when minimum wages were raised in many states, and as noted above, gasoline prices were plummeting. Yes, household purchasing power was theoretically boosted, except said households didn't actually buy anything. Perhaps it's because they're in so much debt, or because so many people's unemployment benefits expired, or that real inflation is a lot higher than reported. Better yet, they claim that in the past 6 weeks, growth in household spending declined, when in fact there was, objectively, no growth in the previous period to decline from. As for household incomes rising strongly, that's just a loose semantic argument based on the plunging yet fudged CPI rate, which also accompanied, by the way, significant job losses in the very segment energy being highlighted as positive effect on the economy given the lower prices experienced. Of course, if households' real incomes rose strongly due to said earlier declines in energy prices, and energy prices have since rebounded sharply, then what they are saying is pure BS. And as for consumer sentiment remaining high, I guess they conveniently chose to ignore yesterday's horrifying consumer sentiment number in plunging from 101 to 95, experiencing its biggest miss versus expectations in 5 years. I guess they just missed that while they were in the middle of their meeting. Next up, an all-out admission of economic implosion. In March, again, just 6 weeks ago, when we were still in winter compared to spring now, the Fed claimed business fixed investment is advancing, the housing sector recovery remains slow, and export growth has weakened. This time they said business fixed investment softened, the housing sector recovery remained slow, and exports declined. Enough said there, and absolutely zero mention of any transitory factors to explain the significant decline in economic activity in a mere 6 weeks. And last but not least, their usual claptrap about the theoretical inflation that not only they know how to that only they know how to measure, which despite the experience of real people, magically stays just below the 2% threshold for rate increases, like the proverbial carrot on a stick. That is, until they inevitably rocket past said 2% due to their own hyperinflationary policies, at which point, like the 6.5% unemployment rate that was supposed to trigger rate increases until a year ago, they simply ignore it. Heck, they even have such contingency language in today's statement, and all statements, as their boilerplate language says, quote, even after employment and inflation are near mandate consistent levels, economic conditions may for some time warrant keeping the target federal funds rate below the committee view as normal over the long term. I mean, what's more BS than mandate consistent levels? Particularly as mentioned above, they recently got rid of 6.5% unemployment as mandate consistent. And what exactly is the normal long-term rate? Is it the 5 to 6% level that existed for the 6 decades before the Fed destroyed the monetary system in 2008? Does that rate apply to an America with tens, if not hundreds of trillions of exponentially rising debts? Anyhow, in March, they claimed inflation has declined further below the committee's longer-run objective, as it should be anyone's objective to create inflation, largely reflecting declines in energy prices. This time around, inflation continued to run below the committee's longer-term objective, partly reflecting earlier declines in energy prices and decreasing prices of non-energy imports. Yes, across the board commodity price declines are better known as deflation, which thanks to years of maniacally easy monetary policy will continue to wash over the world like a tsunami for years to come. Deflation, while it's good for, quote, household purchasing power, is a death sentence for corporations and the ability of everyone to repay debt, which is exactly why the Fed can never stop printing and monetizing and never raise rates. To the contrary, the war on cash I wrote of yesterday will only be accelerated to unprecedented levels when QE4, NERP, and who knows what other hyperinflationary tools are deployed to fight deflation, at the expense of fiat currencies the world round, benefiting only the 1%. Oh yeah, those wise enough to trade their fiat trash for gold and silver. Next up, more extremely dovish comments wrapped up in the same boilerplate Fed speak as always. To wit, 6 weeks ago they said, the committee expects that, with appropriate policy accommodation, economic activity will expand at a moderate pace, with labor market indicators continuing to move toward levels the committee judges consistent with its dual mandate. But this time around they said, although growth in output and employment slowed during the first quarter, the committee continues to expect that, with appropriate policy accommodation, economic activity will expand at a moderate pace, with labor market indicators continuing to move toward levels the committee judges consistent with its dual mandate. In other words, even though what we expected to happen last time around didn't actually occur, we continue to believe it will this time. Which, by the way, is the definition of stupidity. And now, the moment you've all been waiting for. From considerable time in December, to patient in January, to simply, we won't raise rates at our next meeting in March. I mean, how can you top that? By simply saying we don't expect to raise rates in June, and then in June, we don't expect to raise rates in July? No, this time around they took Fed guidance to a new ambiguous low, having boxed themselves in with the defined no rate increase in such a defined period as April. And thus, how did they get around this conundrum? Simple. Just like their ignorance and of reality and the reality of a massive expanding recession, they simply got out of the forecasting business altogether. In the process, ending the post-end of QE propaganda campaign of imminent rate increases launched during Whirlybird Janet's December press conference when she suggested the first rate hike would be in March. And thus, they simply went back to square one, i.e. the same boilerplate language that has been in FOMC statements since October, i.e. The committee anticipates that it will be appropriate to raise the target range for the federal funds rate when it has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. In other words, the Fed, as I predicted, simply compounded the message of the most unequivocally dovish FOMC statement in memory as delivered to Congress in Whirlybird Janet's February Humphrey Hawkins testimony, which frankly sounds a heck of a lot like the Boston Fed's white paper released this week, claiming that the Fed may need to consider the policy of continuing its ZERP indefinitely, which of course is exactly what they must do to prevent instantaneous economic and market implosion. And rest assured, when things get bad enough, either in the economy or the markets they so desperately attempt to manipulate, a massive QE4 program will be announced, despite the fact that the prior three versions created nothing but debt, inflation, and misery. This is why no one is listening, Janet, and why shortly global markets will openly revolt against the Fed's best wishes. In the statement's aftermath, the 10-year yield barely budged, trading at 2.03% as I write near day's end. Will the cumulative power of hedge and sovereign wealth funds front-running QE to infinity be strong enough to offset said revolt by, for instance, Chinese government treasury selling? In time, of course it will, but in the short run, I guess we'll have to wait and see. As for the dollar, it's plunged to a 2-month low, screaming as loudly as possible that easy monetary policy, as I've all but screamed from the rafters, is here to stay. And as for gold, just how predictable could the cartel's typical post-FOMC attack be? In the big picture, big deal. Gold is down $7 and silver and nickel, whilst comically oil and copper are up. However, after such a violently dovish statement, and no reason to believe anything but more of the same is coming, it's difficult to believe global precious metal buying isn't about to take a dramatic stair-step higher, as is central bank monetary easing as the final currency war goes nuclear. To that end, if you are considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.